Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press *0. I would now like to turn the meeting over to Sarah Petoskey. Please go ahead, Ms. Petoskey.
Hi everyone, good afternoon, and thank you for joining the Barometer Readings Monthly Conference Call. Since our last call, we've observed short-term moves in world markets, and through our models continue to monitor the overall health of the markets, and more specifically, closely monitor the themes and sectors we've deployed capital towards. David Burrows, President and Chief Investment Strategist, will share with you our observations and the sectors and positions showing positive attributes through these recent markets, and also highlight some of the areas we continue to avoid. Finally, we will discuss what we see going into year-end. With that, I'll pass it over to Dave.
Hey, folks. Thanks for tuning in today. And what I thought I'd do is just kind of revisit some of the themes that we've been focused in, talk a little bit about what some of the market risk models are showing us, and perhaps where some of the flows are headed. The first thing I guess I would say is that, as you know, for a couple of years now, we've had a view that we are in a secular bull market for stocks that really began as we exited the range we were in between 2000 and 2012. And since then, we've seen slowly expanding multiples in equities and money work its way toward the equity asset class. Our premise has been that leadership in general has been in the developed consumer-led markets that benefit from low-priced energy and plentiful energy. And really that has been a pretty common theme over the last 18 months. So just to recoup, coming into summer this year, we saw a little bit of deterioration in global breadth in equity markets, meaning the percentage of stocks headed higher started to contract, largely started in Europe, and then worked its way through and into the U.S. market in the middle of the summer. So, as you know, part of our job is to make some money when the wind is at our back. Part of our job is to protect capital if things get sloppy. As breadth deteriorated through the early part of August, we start to hit some of the key leadership groups like healthcare, specifically biotech, and some of the consumer stocks, companies like Disney, and wound up hedging the portfolios using S&P 500 futures contracts and TSX minis. And in the period between August 17th and September 20th, as the market hit lows and then retested lows, the various pools and funds that we have were down roughly half as much as the market through that corrective period. And I know there's a lot of people that were concerned about the fact that breadth became as narrow as it was. And as a reminder, we say in all of our presentations, when breadth does get extremely narrow, you do get to a point where things are getting sold out. And to put a point on it, breadth in U.S. markets got to the same low level they got to at the worst point of the correction in 2011, as did the Canadian market, as did the European markets. And in the process of going through the end of August and beginning of September, the breadth models all turned higher globally and started to show improvement. So a common criticism of the market that we have been in is that it is a very narrow market. And that's true. I mean, that's what you have to get to a sold-out market. The last groups to break down through the correction, frankly, didn't break until 3 days before that 1,000-point down day at the end of August. And that was consumer discretionary, healthcare, U.S.-based financials, and technology. And when breadth finally turned up in the middle of September, the first groups, first of all, to make higher lows and then to go on back to highs were consumer discretionary, technology, and U.S. financials. So leadership that was established going into the correction has been the leadership coming out. Now let's drill down to a little bit greater detail. Lots have been made about the fact that there's a small number of stocks that have accounted for a lot of the return in the market, and that's true. We are in a large cap market, a market where companies that have strong balance sheets, meaning they got lots of cash that they can deploy to buy back shares or raise dividends or make acquisitions, are winning in this market. And so we know that there's a small number of names in the S&P that really are leading. We also know that breadth in the U.S. market is considerably better than what we're seeing in the Canadian market. We also know that the Canadian market lacks a diverse list of companies in consumer discretionary sector. It lacks a diverse list of companies in technology. And in financials, we know that at the margin, things are getting a little better slowly in the U.S., while in Canada, things are getting a little bit worse. So what I would say is this. Consumer discretionary continues to lead, but specifically very large cap names. And we can talk a little bit about that. In financials, U.S. financials, specifically regional banks and insurance companies and financial technology, continue to lead and have seen pretty steadily improving relative strength versus the market and versus the overall financials group. Technology, specifically software and old technology, big cash flow generators, are performing particularly well. Healthcare has been notably absent in the bounce off the lows. Healthcare devices somewhat okay, a couple of very specific biotech names, but really we have not seen the money come back. Now, if the concern going into the correction was that China and emerging markets slowing growth would be a drag on developed markets, and I think that that was the major concern. We know that in September, sentiment for emerging market investors hit the lowest level since 1989. In fact, much lower than it was at in the worst point of the correction, the Asian currency crisis in 1998. And since September, we've started to see improving breadth in the Chinese market, which of course has been one of the big concerns. So from a positioning standpoint, we're in a market where around the world, percentage of stocks in long-term advances is expanding and has been expanding since the middle of September. Doesn't have to happen in a hurry, just slow, steady progress. It's still a very narrow market. There's still very clear, defined leadership. It is large cap by nature. If I were to characterize fundamentally, it's the highest quality companies, the ones with the best balance sheets and the best free cash flow generation, which would make sense. These are the companies with the best ability to raise dividends and buy back shares. So as a firm, really very little has changed as far as our targeting goes. It's a have and have not market. Now, off the lows in September, there were two types of stocks that rallied. There was the previous leadership, which we've just gone through, and you got an initial bounce in emerging markets and commodity stocks. And on the last conference call, we said we are unsure whether this is short covering or whether it's real buying. This is going to have to play out. What I will say is as the U.S. dollar has begun to firm again versus euro and yen, emerging market debt and equities again have rolled over and started to underperform. When we look at commodities, the metal stocks have made new lows. The metals themselves have made new lows, copper in particular. The agricultural commodities have backed off and made new lows. Energy, after bouncing close to $50, rolled over again and again has broken down technically. So I would continue to say that we will see short-term tactical bounces in commodity stocks, which will be very hard to trade. This is not something that we tend to focus on. I think we put a couple of small positions on in energy, a couple 3-4%, which fairly quickly came back out of the portfolios. Now, when we look at what's working, we say that equities, large cap equities in general, are working, but it is very much a have and have not market. On one hand, straight equities have been a great camp to be in. And I'm not going to say great camp, a good camp to be in. The S&P is up about 1% on the year. The TSX, as I mentioned, has been lagging. TSX total return is down about 6.5 or 7%. We're pleased with how the mandates we are managing are doing, with one notable exception. The equity fund is up about 8% year to date, so well outperforming both Canada and U.S. markets. Our balanced fund has had extremely low volatility, is up about 4%. Global macro is up 9.5%. Long short is up 5%. So all of those we're pleased with. Let's talk a little bit about income. The income universe has been a difficult place to be this year. The TSX High Dividend Index is down 10.6% for the year. The income portfolio is down 6.3% for the year. So we're not happy with that. We had roughly half the volatility in summer that the index did, so I'm pleased about that. But we would like it to be better. I think there's two things that have impacted the portfolio. One is that income has been a difficult camp to be in. If you took the top 50 dividend producing stocks in the S&P 900 in the U.S., the average of the 50 best dividend payers is down 14% on the year. So both in Canada and U.S. has been a very difficult camp. I would say the second thing that has made it difficult is that in the portfolio, because we try to keep volatility very low in the income portfolio, it's had roughly 30% of the volatility of stocks over the life of the mandate. It's the one portfolio that we have done some currency hedging in, frankly, because to be 100% U.S. dollars is making a one security bet that could go hard against us. But that's cost us some return by being hedged in currency. And I think the third thing is that when we look at what has worked year to date, that portfolio has had more mid-cap securities in it than very large caps, and that's probably held things back a little bit. Now, income portfolio was broadly behind the index and broadly behind the peer groups after the first 3 months of the year. It has come back on a relative basis, both versus the peer group and versus the index. We're happy about that. We'd like to see it better off. So it's making progress. We're happy with the weightings. From a weighting standpoint, the income portfolio is virtually 100% equities, as our risk models would point us to. We've been through a mid-bull market correction where breadth levels got as low as they got to in the worst of 2011. They are now improving, but still at very low levels. The sectors that are leading the market, consumer discretionary makes up 25% of the portfolio. Financials make up 23% of the portfolio. That's U.S.-based financials. Technology makes up 14% of the portfolio. Technology is the strongest leadership group in the market. That being said, there's lots of technology stocks that don't pay a dividend, so they don't qualify for this portfolio. So we have a lowered technology weighting in the income portfolio than the other portfolios. Consumer staples make up about 10%, and those would be the big weightings. 80% of the portfolio is focused in the U.S., and we continue to believe that the depth of the sectors in consumer, technology, and financials is much greater than what we can do in the Canadian market. And we are roughly 50% hedged on currency to keep the volatility down. In equity portfolio is 80% U.S., 31% would be technology, and this is the strongest group. In the technology group, we have some very notably strong names. Microsoft, after 13 years, has broken out to new highs and looks as though it's in the early stage of a significant revaluation based on its strength in the cloud. Cognizant Technologies and Fiserv, both technology solutions companies, also fit that group. NVIDIA in the semiconductor space making new highs and seeing nice multiple expansion. In the consumer group, there's a very core list of names that are showing great leadership. Amazon, Nike, Starbucks, Home Depot, Disney, and Facebook. We have a good, strong exposure to financials, U.S.-based financials, and that's a combination of regional banks, companies like First Republic and Bank United, where small increases in interest rates mean that they will get a significant increase in their net interest margins. And then financial technologies and exchanges, Euronet Worldwide, Intercontinental Exchange, stand out on the exchange side. And again, that goes back to strength of capital markets and improving transaction volumes. So I think that the message to you would be this. We are seasonally in the strongest time of the year. I know there continue to be concerns about all the things people worry about. I think it's remarkable that yesterday, after a terrorist attack on Friday, that the market basically opened flat and rallied all day long. I've been asked lots of times in presentations, what about black swan events? And I've always said, markets will behave the way they are technically set up to behave going into a news event. So we know on September 11th, 2001, market was very technically weak, had been selling off for 3 weeks going into that terrible event. And of course, the market got creamed for days afterwards. Market was weak technically going in. I've often made reference to the day of the London train bombings, where the market opened down 300 points in the morning and closed up 250 points on the day. The market was set up technically on a technically sound footing. So the fact that the market sucked up that bad news from Friday and was able to rally all day long yesterday, and that Europe was up close to 3% today, should tell you that this market is on very good footing. So seasonally, we have a tailwind. 75% of returns in the MSCI World Index in the last 30 years have come in the final 2.5 months of the year. We're in that period. Breadth readings got to extreme low levels. We were happy to have protected capital well through that period, and we're now seeing breadth expand slowly. We're seeing money work its way into equities. From a sector perspective, there's very clear leadership in technology, financials, and consumer. In large cap names, which has been our focus, we've continually moved up the market cap curve in the portfolios. We're relatively fully invested. And in the balanced portfolio, the one point that I would note is that on a rifle shot basis, there have been some very strong performances recently out of some of the corporate debt. So while there have been concerns in the stock market, the spreads in corporate debt have not widened over the last few weeks, and there's been opportunity on the corporate debt side. So that's sort of where we are for now. Certainly, if there's any questions, I'm happy to answer them. But I do think that we're in a market of have and have-nots, and the portfolios are well focused in the areas of haves. And I look forward to talking to you again in a month or so.
So before we take any questions, I just wanted to let you know our last call of 2015 will take place on Tuesday, December 15th at the Standard Time, 4:15 Eastern Standard Time. If you'd like further information or marketing materials to use with your clients, please reach out to our team. Nick Hamilton, Andrea Robakovic, or myself are happy to answer any questions you may have. And also, please remember we're focused on providing our clients transparency. So if you require the recent holdings report or would like to speak with a PM, please do not hesitate to reach out to us. And with that, we'll turn it over to any questions.